does the economic outlook justify a 20% drop for the S&P 500 and a far larger drop for many other stocks?
Well, we have a good amount of slowing to come in the U.S. economy and the world economy this year into next. And we have higher interest rates. We have to discount assets with higher base interest rates. So this combination together, right, does take us a good step back from where we were during the boom year of 2021. So I think we've discounted a great deal already. I absolutely believe recession isn't a necessary component of how we would get to a lower inflation rate. We have a couple of really good fundamentals going on: the slowdown in consumption, the recovery in domestic goods production in the U.S., the sharp rise in imports. All of this in time is going to help us get back to a lower inflation rate. But if we're going to take this and try to rapidly get us to a lower inflation rate, then we sharply increase the odds of recession. So I think we're not priced for recession, but we've come a long way to pricing in that risk, and that risk is very present.
Stephen, how long have you and I been talking? What,
well,
20
years?
20 years? 15, 20 years? Yeah, about 20 years. I don't know about you. I'm not sure I've seen an economy turn this quickly. Maybe not the economy fundamentally, but certainly the sentiment around it turn this quickly in all that time. I'd like to hear your comment about that, whether you agree or disagree, and try to explain to our audience what exactly has happened.
So this has been an incredibly sharp about face in the approach to monetary policy. And let's be clear about that. I think that we have seen a boom year. And the main thing that's happened here is two things have driven up inflation. Broad-based stimulus, too broad for an external shock in the form of COVID. Again, we had very severe, concentrated negative effects in industries like hospitality, travel, and leisure. We didn't just rescue those industries. We applied broad-based stimulus of a magnitude never seen before to that narrow problem. Now, what have we also done on the supply side? We obviously have a series of shocks. It's been impossible to import the quantity of goods that the COVID economy and those lifestyle shifts required. I mean, when you're up 50% in autos demand and down 50% in public transportation demand, nobody can stabilize prices in that environment. Now, what we've done, and the way this would look forward, is that we are now seeing consumers have to approach inflation without help from the government. There are no more checks this year. And if you take a look at the first quarter, federal spending is down 33%. So we've taken out that subsidy, and that's a large drag on after-tax income. Now, if you combine that with the fact that we have these supply shocks on the way, the Fed has never been able to address those before. So the main thing that's happened is that the Federal Reserve said, be patient. Let's be careful here. Let's foster a full recovery, to say, no, let's shut down inflation, and we need a rapid change in policy, including rapid quantitative tightening. And those are the words of Vice Chair Brader. So this is a real about face in terms of monetary policy, and this is what's gotten you double-digit declines in stocks, bonds, and a 20-year high in the dollar.
Ironically, we sent out stimulus, trillions of dollars, maybe when a lot of people needed it, a lot of people didn't. Now they do need it because of inflation, and they're not going to get it. Stephen, are you and your team expecting more drops for the stock market? Is this it? I mean, I'm looking at some scary technical charts over the week. I mean, I had to close my computer because you could make the case for a lot more drops to come, or maybe this is it. What do you think?
Look, I would have to say the forward-looking news that we have on inflation is clear enough for me that we don't need just a bearish view that there's no other way forward. I can't tell you, whether today the bears will press it harder. I think they're really in a battle right now between bulls and bears. I think sentiment is rotten. I think that there's been a great deal of repositioning, and the precondition for stability that we should have in risk assets is a stabilization in the bond market. The long end of the bond market is, I think, again, a higher probability bet that this slowdown, again, is getting priced in. So I feel like risk reward has moved into greater balance at this level. I would be a little bit careful. We're not going to say, well, this is the time to just pile back into 2021's winners. But I think if we stay with quality assets, I think that we are better off being long quality equities now at this level than after what the shock that we've had to absorb from policy.